I'll be your host for this evening, but there'll be several of us presenting. My name is Carlton Lane Fiesta, broker owner of Monarch Mortgage. Monarch has been in business for about 4 years now. As a company, I've been a loan officer for over 15 years, though. Okay, and we've been doing a lot of great work and transactions through over the years. Okay, and let me just go ahead and move on to some next slides here. And give me 1 second. Oh, by the way, we will be moving around a little bit, so bear with me. All right, so the first thing is we don't do this by ourselves. We are a company. So we have about 11 people with us right now. And of the people that you see on the screen, we have about half of us here, if not more, in the office. So you're working with a team when you're working with Monarch. It's not just myself. And we'll be starting off with several of our members presenting here shortly, starting with our senior loan officer, Ken Smith, who'll be coming up and talking to you guys about a few things. By the way, if you guys have any questions, feel free to either unmute yourself or put it in the chat, and we will make sure you guys get answers. We will make sure that you guys get answers to all of your questions, okay? Ken, come on up. Well, give me 1 second, Ken. I'm sorry. I wasn't ready. I want to make sure the audience can see you. It is almost better. All right, let's go.
My name is Ken Smith. And just want to talk to you a little bit about my background. I've been in real estate for a long time, 30 years, all different aspects of it. I'm originally from Detroit and went to Michigan State. And I always wanted to be in real estate. So 35 years ago, I decided to move here to California and sell real estate, mortgage financing, and basically I have moved back. I've been in all different aspects of it since then. So here today, we're going to be talking about a lot of our products here at Monarch. We do all kinds of things: construction loans, HELOCs, reverse mortgages, purchase money loans. So basically, if it's related to real estate financing, we do it. So I look forward to talking to you about some of these programs. And so get your pen and paper out. You're going to learn a lot. And after this seminar, you're going to know more than 99% of all your competition, because what we're going to go over, most people don't know. Even people with loan officers, licensed loan officers, won't be aware of some of these things we're going to talk about. So very important. It's going to give you an edge. It's going to help you do a lot more business moving forward. So without further ado, we're going to introduce. Oh, you want me to talk about the? Yeah. Okay, so we're licensed. So I'll tell you about some of the information. We talked all these different programs. We're licensed in all these different states: California, Texas, Florida, Michigan. So we can get it done if you have a loan in any one of these states. Of course, if it's some type of a commercial loan, we can do it anywhere in the nation. And so we have a lot of things that give us, kind of helps us to help you guys win. And one of the things we'll help you when we have a close in 14 days. This is a purchase money. Keep in mind, we can open up on Monday and close on Friday. This is provided that everybody's on the same page. You got title, you got escrow, you got the limits, everybody's on the same page. Do a rush on the appraisal, and it's also provided that the borrower responds timely. You give us all the paperwork we need to register your loan, to answer all conditions, and we can wrap it up in 14 days. That's almost unheard of in the market, but we can do it. We also have a match it or beat it program. So if you get a loan estimate from a lender, bring it to us. We'll look at it, and we'll dissect it, and we'll look and see if we can match it or we can beat it. And in most cases, we will be able to do it. Give us that opportunity, we'll be able to make it happen for you. So, we are a mortgage broker. So the advantage to being with a mortgage broker versus a direct lender, or some of the differences, we're approved with multiple lenders. We have more programs when you're a mortgage broker. We have more programs available to you. We can find the best fit for you as a borrower. Very flexible financing, there's competitive pricing, there's wholesale pricing. Whereas when you go to a direct lender, they only have basically very limited sources, very limited in-house products, and it's very strict underwriting. So we have the flexibility to really do some manual underwriting and kind of underwriting outside the box, so to speak, for lenders. So that's one of the advantages of going to a mortgage broker. You're basically giving yourself a chance to find that product that you're looking for. You're not limited when you just go direct lender. And we may have 2 or 3 products to talk to you about. So we're approved all these banks, as you can see. We would United, Wholesale, the UWM, Loan United, Home Express, etc. And this is just a small list of who we're approved with. We're approved with probably over 30, 40, 50 banks. And if we're not approved with them, we can always get approved to make it happen for you. They got a product that you need. So now we're going to go into the down payment assistance program. And I'm going to introduce one of my.
Well, we got a few. But this slide, guys, is just dealing with the different programs that we offer here. We're going to be jumping into some of them more specifically, but we just wanted to give you guys an idea of some of the stuff we offer. But the next loan officer that's going to be up presenting is going to be Miss Arlette Hamilton. So welcome Arlette Hamilton to the stage.
It's my pleasure to be here. I love real estate. I come from a real estate family. I've been in real estate for almost 30 years. Yes, October will make 30 years in real estate, and I love it. I live it every day, 7 days a week. So excited to be on the loan side because I was previously more and still am doing investments and things. So, but love the loan side of the business. And I'm here to talk about conventional loans. Let's jump right in.
Sorry, I'm addressing something real quick. Give me 1 second.
Well, that, of course, conventional loans, we're all familiar with FHA, conventional, VA. Conventional loans are considered more straightforward, streamlined. There's minimal documentation, and a lot of loan officers might say that that's one of their favorite loans to do because, like Ken mentioned, they close quickly, they're straightforward, and it's a streamlined.
I want to make sure. Can you guys hear us out there? You hear us? You hear all that? Okay, perfect. Cool. Okay.
All right, so we have 3% versus 5%. Now, with both of these programs, we have a minimum 620 FICO score that is required. Your client does not have to be a first-time home buyer. Some people think that, but no, you don't have to be a first-time buyer. However, the borrower must occupy the property. With the 3% down product, we're talking 1-unit property. So single families, condos, PUDs, planned unit developments. With the 5% down, like it shows up top, we're talking 2 to 4 multi-unit properties. And interestingly enough, too, with the 3% down program, you do have to, mortgage insurance sometimes can be lower because we're usually talking about a borrower who has a higher FICO score. With the 5% down, you have what's considered a no self-sufficiency rule with the conventional product. Unlike FHA, which someone will touch upon later, FHA does require that the income from the property is able to take care of the mortgage. You do not have that case with conventional. So that is a great feature of going conventional. And as I mentioned before, the process is very streamlined. We can close, like Ken mentioned, sometimes 10 to 14 days if everyone's on board, able to make it happen. So these are some of the types of conventional programs we offer. You have conventional home 1, the W-2 only, and the home possible loan. Now these are Freddie Mac programs. With the difference between the conventional home 1 and the home possible is income. So there are some programs have income restrictions. With the conventional home one, there's no income restriction with that product. So if a person makes lots of money, they can still take advantage of that. Again, you still see the minimum FICO, which is going to be a running theme through most of these programs. The Home Possible does have income restrictions. The borrower needs to be low to moderate income in order to be able to take advantage of this program. There's homeowner education requirements with that. And one other great thing about Home Possible is that if they need a little boost with income and they might need someone to help them qualify, co-borrowers don't necessarily have to live in the home. Now, a lot of us are familiar with W-2 only. It's a very straightforward program product. It's our salaried employees. Those who are hourly, they have W-2s. We'd only need 2 years of W-2s and 1 month of pay stubs to be able to help someone just do a straight W-2. We don't need taxes. So again, minimum documentation. So we're able to the loan is being able to be underwritten quicker, and you don't need a lot of documents, no full documentation.
So I want to make sure that we let the audience know questions are able to be asked at any time. So did you guys have any questions so far on what she's presented? I don't want to just keep speeding through stuff. This is all here for you guys to learn and ask questions about what you may or may not know or how it works and all that good stuff. So yeah, go ahead.
I do have a question.
I'm sorry, what's your name?
Anita.
Anita. Okay.
Yes. Hi, everyone. On the conventional home one, is there a specific minimum income requirement?
I mean, well, based on the prices of Los Angeles,
Right.
trying to buy here, the minimum would be that. Because if a person makes, say, 40,000, it's very difficult to purchase a property. So there's no real set minimum. And Carlton will touch on down payment assistance also, so maybe they can get a boost with that. But it all depends on, where they're trying to purchase. If they're trying to purchase in LA City, they don't mind going out and maybe getting a less expensive property. So yeah, there's no set minimum.
Yeah, there's no income limit if that's what you mean. Like there's no they don't have to earn below a certain amount or what.
Or a minimum amount, just
Like
depending
a
on
floor.
whether or not they can afford the mortgage.
Yes, exactly. There's no floor, and with that, there's no ceiling.
Now with the, I'm sorry.
Yeah.
Now with the multi-unit, now did you say that, and I guess that's possible.
On the previous slide.
Oh, yeah.
I'll take it back.
So on that, when you talk about the 2 to 4 unit, now you did say that do they look at the rent as?
No, that would be an
Income.
FHA rule. It's called self-sufficiency
Right.
rule, which whoever's presenting on FHA will touch on that. But I wanted to highlight that with the conventional 5% down for units, there is not that self-sufficiency rule. So if, say for instance, say it's a duplex, the borrower is going to live in one and they're renting out the second unit. Say it falls short of the mortgage, meaning when they combine with what they qualify for, obviously they have to qualify for the loan, but it doesn't have to meet that mark of the mortgage amount, the mortgage,
Okay.
insurance, tax insurance. So yeah, that's not
So
that
it's a
part of the rule.
benefit really when it's done that way?
Yeah, because now they're like going FHA, 2, 3. Let's consider it's 3 to 4 units. Say the mortgage is 5,000, but yet the rents on the property is 4,500. It's short, and therefore it won't be approved because it falls short of what the debt service is every month.
Yeah, I just want to make sure. When you were going to ask about the rents, did I answer your question or was
No, it did.
Okay.
Okay.
All right, cool. Because there's a lot of aspects to units. There's how much the rents are, how much the appraiser's opinion is,
Right.
if you're using 75% of it, if it's vacant, if it's occupied. So this is the forum to ask all those different kind of questions. Okay. There's no dumb question today, guys. Okay.
I'm sorry, I got one more question. So say if you're going to have 2 people on the loan. And what if one of the people on the loan don't have 2-year work history, but one other person does?
Yeah, everybody needs to.
That's right.
Question real quick before we gloss. The person that doesn't have 2 years of history, have they been in school?
No.
Okay. Typically, most people have 2 years of work history past like 18 years old or
Well,
whatever.
I should say documentable work history.
Okay, so even when you get into undocumented work history, sometimes you can even make that work. Okay, it just depends on what the employer is willing to say. If they're willing to give any sort of 1099 even, and to say that that person worked here. So sometimes we can look at that because what they really care about is the most recent, what they're earning now, and they just have to show stability. So we have to say that we're doing something for 2 years. So school is, and I just want to throw that out there. If somebody was in school for whatever, you could use that in lieu of work experience as well.
Thank you.
And we still got more slides for you, but yeah, we'll.
Transferable or removable? You tap into that?
So with once you get to, is it 80%?
Yeah.
LTV, it becomes cancelable. They can cancel the mortgage insurance on.
Oh, you're talking about MIP, okay.
Yeah.
Okay.
Yeah, the good thing about conventional loans too is you could also like do split premiums and stuff. So basically, on conventional, you have a lot more flexibility when it comes to mortgage insurance. You could pay it all off in one. That's a single premium. So you could buy out the mortgage insurance for the life of the loan. We don't recommend it because they'll probably have 20% equity in 3-4 years anyway. By the way, things are appreciating out here. You could put down like a portion of the mortgage insurance and pay monthly on the rest, or you could just do a standard, which most people do, a monthly payment on mortgage insurance.
If they paid it up front and the values went down, are they still good?
They still good. Yeah, that single premium, you're good. So now keep in mind, if they refinance or something like that, now they're subject to mortgage insurance if they don't have 80% loan to value. So that's something to keep in mind.
If they
But
go
if
down,
they-
they can't refinance it.
Exactly. No, I mean, like, but just bringing that up because they could become subject to it if they try. Right. Yeah. All right. Let's get to the next slide here. Oh, sorry. This was the one you just did. Okay.
And we have home ready conventional loan, which is a Fannie Mae product. And again, we see the 620 minimum FICO, which is the theme throughout these programs. Now, this one does have, as you can see, an income limit, which is the person must fall below 80% of the area median income. OTC, which is one-time closed construction loan. This is a great product because it allows the borrower to actually finance the construction loan and the purchase loan in one transaction. So they're able to save on fees. The other great thing about this is that they're able to make only interest-only payments during the construction phase. And they can lock the loan either before or during construction. So something that people can take advantage of because they can, if they have land and they want to custom design their own home, they don't have to do two loans, which happened in the past. They can just be one loan, very straightforward, streamlined process, and down payments in the 5 to 10%.
Question. Is there a max loan amount? The clear amount?
Conventional loan limit. So you're going to be dealing with like LA County, well, whatever the county is that is being, the properties, because it's one time closed, you could buy land and build a house, right? But you're subject to the county's loan limit. So in LA County, it's like $1 million or 1.2 million, I believe, that you can purchase a single family in LA County. But if you go to Riverside, then you're in something like 800,000. So depending on the county that you're in, it's going to be subject to that loan limit.
Okay.
Does that make sense, Jazz?
Yeah, but there's no, as far as the repair, they combine the two, what the repairs are. And with the loan that you're borrowing, or they're all one loan that includes.
Exactly.
That.
Yeah, and it's based on a future, like the appraised value, the finished product. So that documentation needs to be submitted so they can appraise it, and then they therefore give an LTV based on what it's going to become. And that's how.
So let's just say, as an example, there's a plot of land in Riverside, okay? And you have a client that wants to build a house, okay? Let's say the plot of land is $200,000, and it says it's going to cost $400,000 to build this house, okay? So the total loan is $600,000, but the loan includes buying the land and money to build the house in one loan, okay?
Got it.
So that's why I call it a one-time close, because it's like a construction loan and a regular loan in one.
Always working more than. Right.
Craig got a question?
In your previous statement, you said that, or I guess you said it before. Is this something you can do out of state?
We have to be licensed in a state for this one. And we're licensed in Michigan, Texas, California, Florida, and Pennsylvania. So just, depends. We're growing. You have a state, we got a state in mind?
South Carolina.
South Carolina? Okay, we decided to stop dealing with people from South Carolina. That's good. Okay,
Respect.
every year I try to do like another round of 5 states. It's just a question of where we're relocating to, what we're seeing the most business in. We have some states we got licensed. We're licensed in Nevada, did 1 loan in 2 years. I let it go.
In Nevada?
Yeah.
Really?
Yeah. So it just depends. If there's not enough activity there, we got to pay fees on every state and stuff like that just to maintain a license, have bonds and stuff like that. So every state doesn't make sense. But if it's something you're going to do a lot of business in, we'll happen to be your South Carolina lender. So just let us know if that's where you're looking to go. But to your point, a lot of people aren't willing to build houses unless it's in a cheaper market,
Right.
like a South Carolina and stuff like that. So got to keep that in mind too.
Well, I was just wondering about Missouri. That's a market that, are you guys considering that?
Not so you're like the second person in 15 years that asked me about Missouri, so I can't say yes. But hey, you know what? The last person was just last year, so y'all are picking up.
Yes.
St. Louis is looking.
Stress things out there. My girlfriend's dad lives on the block. That would be just, kind of right for the chicken.
Same with Detroit.
So you got to be careful though when you say distressed properties, because we're talking about a rundown property, and that's a renovation loan, right? If we're talking about something that doesn't exist, you want to build it. Now we're talking about a one-time close construction.
What if you just wanted to tear it down and build it? Would that go on there?
I don't know if they'll do it. You know what? It may, and it's funny because I had that thought recently, but I didn't ask because I believe most of the time, historically, it's been the land has to be vacant. They don't want nothing done to it. Because I think that you're crossing over to where it may be a renovation loan instead if you go that direction versus it being a construction loan, even though it's primarily a new build. Right.
All right, next up is Carlton talking about down payment assistance.
Okay. Thank you. I'm gonna give myself a hand. Yeah. All right, guys. So a little bit about me before we begin, and I'm gonna be jumping back and forth because I'm the guy clicking this next slide. But my name is Carlton Lane Fiesta, 14 years in the business. I guess some of the things you don't know about me, I got a bachelor's degree in business, Cal State Northridge, member of Alpha Phi Alpha. I'm pretty much a part of all the local boards. So you might see me at Greater Los Angeles, Inglewood, Southwest, Consolidated Board, doing a lot of business here in the community. And that's a little bit about me. I built my business on down payment assistance. Basically, when people talk about have a niche to what you do, I was like, I'm going to do what nobody else does. So my segment is going to be down payment assistance. So I'm going to hop back over here and talk to you guys about it. All right. Now, the first thing I need to help you guys understand is that a lot of banks don't do these loans. A lot of banks don't do these loans because they're not very profitable. They take a lot of time. The loan officer loses money off the jump because loan officers are paid off of the loan. We're not paid off of the sales price like a real estate agent is. So if we give you $100,000 to your client, we made $100,000 less on our commission. So people have backed away from it, ran from it. Not to mention some of these programs are 3 to 4 times harder than just doing a standard loan. Okay. So a lot of people come to me for these products because they can't go to nobody else, so they can depend on the close, number one, and then actually are familiar with all the ins and outs of these products. So the first one up here is a homeownership program, also known as HOP. HOP is available for unincorporated LA County. So basically everything outside of LA, and a few places that come to mind, if you guys have heard of Westmont in Los Angeles, it's kind of where Jesse Owens Park is at. Unincorporated LA, West Athens is unincorporated LA. So this is doing a lot of the outside of the city of Los Angeles type of loans. There's also participating cities that can choose to participate in this Culver City participates in this particular program, for example. So on this particular flyer, you see at the bottom, I know it might be small on your screen, so you might have to zoom in. You'll see all the unincorporated cities. And some of the main things to this first one on the left side is the income limit, okay? Because it goes by household size and how much the adults in the household make, okay? So for example, if you have one person on this loan to qualify, there's two different tiers. One, if you're low income, you can get $100,000 from this program. If you're moderate, or what they define as moderate, you could get 85,000, okay, to help you towards with your down payment and your closing costs. Good news about the program, there's no minimum credit score requirement. We just closed with somebody that started off with a 550. We got it to a 600 at closing, but we were able to even secure the funds with a 550 credit score, okay? And for example, if you have one person in your household, let's say it's just you, and you earn below $84,000, then you're eligible for $100,000 from this program. And funds are still available today on this program, okay? Any questions about how, before I move on to the next one, unincorporated LA? No? Okay, cool.
What do you consider a moderate income?
So moderate on this table is listed as 89,550. That's where it begins, but also keep in mind the household size. So if you have 4 people, then you're talking about the income limit of being below 127,000 for a family of 4. Yeah.
I see.
Close times on that particular program can go actually between 30 and 45 days. So they're not super slow. They're relatively decent compared to regular loans. We also have the LA City LIPA Micro program. So this particular program, they are out of funds right now, but they come out with funds. They have like a schedule now because it's become extremely popular. Keep in mind, when we talk about a borrower getting $161,000, first of all, it's life-changing because they probably would not be able to afford the house without the program. So the payment is typically $1,000 to $1,200 less than what they would have been paying if they wouldn't have got the money. So it really is helping create homeowners with the LA City Down Payment Assistance Program. So the income limits are kind of at the bottom there, and 1% minimum borrower contribution is the main thing you need to know. So even with down payment assistance, borrowers have to have money for earnest money deposit, for the appraisal, for inspection. So you can't take somebody who's completely broke and just throw them in a house. They have to have some money to at least open escrow, right? And that's the LA City LIPA Micro program. Any questions about that? I'm gonna hit the next
So
one.
they're out of funds?
Right now they're out of funds, but I want to say as early as June they'll have more funds. And for this type of program, you kind of want to identify people because when they do come out with funds, it's typically a Wednesday at 9 a.m. And a person has to be in escrow, have a signed purchase agreement, even before they even have the funds solidified. Okay, so they have to have a signed purchase agreement, then you can reserve the funds. What is some other documentation you have to sign, but you can reserve the funds at that. So that basically means they need to be shopping probably even 2 or 3 weeks before they even have the funds, just to agree upon some terms so that you can reserve the funds once they roll out.
And you said that's in June, May?
Correct. I'll double check that, but while I do that, any other questions?
So, but it's, once you have that, is that like a guarantee? Is, how do you know for sure that you're gonna get that funds?
Yeah, once it's reserved, you're good. Yeah, the only thing that's gonna mess that up is if you don't close. Yeah, but it won't be because of the city, it'll be because of the loan, or you quit your job, or your credit score got messed up, or other things that can happen on the transaction. But the city, as long as you reserve the funds, you're good to go with them. And the question was, when do they have funds again? So I'm pulling this up on my cell phone. In June 10th would be the next time the low income comes out with funds.
Yo, how big are those pools?
Moderate is July 1st. So you can. Sorry.
How big are those pools when they come?
How big are the pools? So how many reservations do they give out? Basically, June 10th is going to be 20 people. July 1st is going to be 10 for moderate.
And that's for the whole.
That's for all of Los Angeles. So LA City is specific to the city of LA. So we're not talking Compton or Long Beach or Inglewood or Culver City, just Los Angeles. Yeah.
And also it's better to just have your client register as soon as it opens up at 9, you get in.
Yeah.
Straight.
Yeah, but every time they've opened, and the client's been ready, I've been able to reserve funds. So, if they're open at 9 a.m., we're pretty much, I mean, excuse me, if we have everything ready to go by 9 a.m., I'm there with my coffee, ready to click stand at 9 a.m. because I want to make sure they get the funds reserved and everything is kind of, downhill from there. Just make sure they got the money. So we gotta start all over again because somebody walked in late. I'm kidding, guys. All right, moving on to the second slate of DPA programs. Now, these ones honestly are a lot easier because first of all, they're getting less money. They're just covering the basic down payment. Some of them also cover closing costs, but it basically allows the borrower not to have that 3% or basically like I would say up to 5% is what you could kind of get from these programs to cover your down payment and closing costs. Cal Halfa had the Dreams for All. This is not Dreams for All I'm talking about. Dreams for All is already gone. Okay. This right here is just dealing with standard Cal Halfa loans where people are putting either 3% down or 3.5% down, and they can get that money from this program to help cover the down payment and the closing costs. It is a loan. I'm gonna double check real quick. Yeah, the Cal Halfa 2 slides, those are a loan. It does have to be repaid. However, the down payment assistance has a 1% interest rate. It's a 1% interest rate loan. The closing cost is a 0% interest rate. So it's basically like free money, right? So I've had some people in the past qualify for a similar loan, but go with Cal Halfa just because the interest rate is cheaper and you don't have to come out of pocket. We've used these types of loans to have borrowers pay off their debt and then use the down payment assistance to purchase the house. So 640 minimum is the credit score on that. And they have some of the higher income limits out of all the down payment assistance programs. I believe it's close to 180,000 now in Los Angeles County. So most people are able to qualify. You can even, if somebody's married and let's say combined they earn $300,000. But let's say they're 150 each. Well, you could take the husband off the loan and just qualify with the wife, or vice versa, right? And still fall under the income limits for Cal Halfa. So very flexible to get that done. Chenoa is very good. It's for duplexes. So if you have borrowers out there trying to buy units, Chenoa will allow you to go up to 2 units and cover the 3.5% down in either in a loan. One that's forgivable, they have different versions of it. One is forgivable after 3 years. The other one is repayable within 10 years. Okay. Typically, we offer whatever helps the borrower qualify and whatever they're comfortable with. Because in most cases, people are refinancing way before 3 years. So even a forgivable loan within 3 years, some borrowers would rather just have a regular loan because they're going to plan on paying it off anyway within a year or two through a refinance to lower the rate. So any questions about these so far?
You said it's forgivable?
The Chenoa one has 2 versions. One is repayable. So like they'll give the money for the down payment, 3.5%. They'll give 3.5% down in the form of a loan. If they make the forgivable one requires no payments for 3 years and it just basically falls off, right? There is like a scale date, like monthly or whatever that it decreases by. So if they decided to refinance like in a year, they've been forgiven for a portion of it. But after 3 years, it's completely forgiven, right? So that's the forgivable one. The loan portion, it's keep in mind 3.5% down. Let's just say it was $500,000, like 18,500, right? Something like that. And if that's in the form of a loan, it's going to be a 10%. It's going to be a 10-year term, and the rate is 2% higher than whatever the first was. So if they qualify for a 6% FHA loan, then it would be an 8% loan on a 10-year term for $18,000. But just to add that to the DTI and help them qualify.
And it's forgivable in 3 years.
Well, the one that's repayable, no. The one that's forgivable, yes. So 2 different interest rates depending on which one you're going with.
Okay.
It's probably about like a 0.5% difference, higher for the forgivable one than it is for the repayment. But still, if the client doesn't have the money, sometimes, and to the audience, everybody, okay, the client's broke. They don't have the money. It's okay. It'll help them get in. I've had people use programs like this, and 2-3 years later, they got $60,000 in equity. Rates have gone down. Hey, I want to refinance, pay off the down payment assistance. I got to be in the house, get a lower monthly payment, and guess what? They came in with no money for the down payment. They might have had to come in for closing costs. They might have had other things. Okay, but I'm just saying, don't turn your nose up at somebody having to use assistance to get into a house, because at the end of the day, it could really be the best thing for them. Any other questions about these 3 before we move on?
Closing timelines.
Closing timelines on these 3 in particular are 30 days or less. Yeah, CalHalfa is relatively quick nowadays. They probably have 1 to 2 day review on the CalHalfa side. Most of the banks that do CalHalfa are almost specializing in them now, so it doesn't take a long time to get a CalHalfa loan closed. Chinoa, very, very similar. You might even be able to get a lower time frame on that, closer to 21 days.
I do that. PMI, are there any of these programs that waive that?
They'll waive mortgage insurance. Out of these, no, because this one's FHA, so you can't. Out of the conventional one, you can use a portion of the assistance to buy out in line.
Okay.
But it's not waived.
It's not waived,
It's
okay.
not waived. Yeah. We do have there are conventional lender paid mortgage insurance loans where the mortgage insurance is basically rolled into the rate. So but technically it's still included, which is the case most of the time we're talking about waiving MI. But it does exist to where they don't have to pay it separately.
And if it's paid, you don't factor that into the ratios? Even though.
Oh, no, you don't. Yeah, you don't have to. If you do a single premium or if you do a lender paid MI loan where there's no MI present, you don't have to factor that into the
Kind of like the lender paid because it's the rate interest is deductible. The MI isn't.
See, a lot of people don't know that. That's why I like Clarence right here, okay? Let me repeat what he just said in case y'all didn't catch that, okay? So when somebody buys a house, they can write off the interest, right? When they go to their tax superior to do taxes, you can write off the interest you're paying on the house. If you did not want to pay mortgage insurance is not tax deductible, okay? But if it's lender paid MI, the lender pays the mortgage insurance. It basically appears as discount points to the client. Either it'll be discount points or it'll be rolled into the rate. Either one of those, discount points or the interest rate, is tax deductible. So it saves the client a little bit more money doing it that way versus them just buying it themselves from the house. Okay. All right. Moving on. Next step, we'll see. I got another side of here. I'm gonna keep pushing. All right. So Ryan had a little baby that has a medical issue. So he was not able to make it today. I'm gonna jump in and cover his portion real quick on FHA loans and prayer go out to Ryan and his baby. All right. FHA, 3.5% down. I think most of us know that. Okay, but I would also share that 3% down conventional is really the cheapest down payment, not FHA, because a lot of buyers believe that FHA is the cheapest down payment. It is not. It is actually conventional, 3% down. However, you still might run into some situations where FHA might make more sense. FHA is very good with low credit score borrowers. Okay, so we can do an FHA loan with 500 credit score with 10% down. So I closed one of these. Borrower had like a 520, but she was getting an inheritance, so she actually ended up putting like 30% down. But with her being above the 10%, we were able to do a loan FHA with a 520 credit score. As long as it's above 500, we can do that. 580 is the minimum for 3.5% down. So if you have anybody that has a 580 and up credit score, we can do 3.5% down. Now, conventional typically starts at 620. If you have a 620 credit score, going with a conventional loan, you're going to have a high interest rate, high mortgage insurance, So doing 580 on FHA becomes a lot better for the client's payment if they have a 580 credit score. Any questions about these three? Everybody know FHA pretty well. Well, I guess the bottom line is if a client doesn't have good credit, I wouldn't rule them out. The next question is, what do you have saved, right? Or what can you get in a gift? So we can do that.
Do we all allow gifts?
They do. I think every program we've covered so far allow gifts. Gifts are becoming more acceptable no matter what program you're doing. Down payment assistance, you can still get gifts.
And it has to be a relative.
It could be a close friend now. Yeah. Relative now used to, have to fight with, no, don't put cousin, put brother. They don't care anymore. FHA has this verbiage that says a closely documented, a close friend that's documented or something. I had an underwriter ask me for a picture. I'm like, first of all, how you gonna know that's them? You know what I mean? So it's just like, what are we doing here? But you could get a gift from pretty much anybody now. So FHA, we recommend for 2-unit properties if you're going to do a duplex because there's no self-sufficiency rule, like Arlette talked about earlier on a conventional loan. Only for 2-unit, FHA does not allow self-sufficiency. Self-sufficiency basically means if that they want the rent times 75% to be greater than the mortgage. And in today's climate, with high prices and high interest rates, and in some cases low rents, a lot of 3 to 4-unit properties are not self-sufficient. But a 2-unit does not have that requirement. So you can purchase a 2-unit, doesn't matter what the other unit pays, and close going FHA. We also have 203K renovation loans being offered. A lot of people forget when they are looking at the house and I see a house, it's run down, I can buy it for $400,000, $500,000. You need to add the cost of renovation on top of that, okay? Because it's gonna take you another $100,000, $200,000 to renovate it to get it the way you want it to be. We're still talking about a $600,000 loan or what have you, okay? But we do offer renovation as well if they would like to take a 2-bedroom, 1-bath and make it a 3-bedroom, 2-bath. In some cases, that may make a lot of sense, and you can refinance it within a year to get out of it has a higher interest rate typically, but you can get out of it within a year. 3 to 4-unit FHA properties, they're subject to self-sufficiency. This is what I call a unicorn. I've never seen one. No, I was kidding. I had one done early in my career, but it was because we were able to buy down the rate and stuff like that. So you can still do a 3 to 4-unit on an FHA property, mainly if the way that these things qualify is off the appraiser's opinion of fair market rent. So if somebody's paying $1,500 for a 2-unit somebody's paying $1,500 for a 2-bedroom, 1-bath, but we know market rent for a 2-bedroom, 1-bath in LA is probably closer to $2,000 or $2,500, right? If the appraiser comes and they say, hey, we believe, okay, the person's actual is $1,500, but we believe they can get $2,500. We have to use the appraiser's opinion of fair market rent to do self-sufficiency. So it might still work if the appraiser is realistic in what people are paying today. Now, because it's their opinion, and we don't know what kind of appraiser you're going to get, that's the tricky part, right? Because if they go out there and say, oh, they pay $1,500, so my opinion of fair market is $1,500, because that's what they're paying. Well, that's in their opinion how that should work. But there's others that are like, nah, this is $1,500, but we can see there's other people renting in an area for $2,500, and we can still make that work. All right, any other questions about FHA loans?
So to clarify, it's not the actual, it's whatever the opinion.
It's the opinion.
I always thought it was actual or
No.
opinion in those.
It's the opinion even occupied, okay? And it's also includes the because this is FHA, so they have to occupy the property. So the unit they're going to occupy is included in that. Any other questions about FHA? Online, y'all with us? Online, y'all so shy. Okay, we'll keep it going. All right, so this is FHA Streamline Refinance. We do those as well. If we put a client on an FHA loan, You guys ever help somebody buy a house and you're like, oh my God, I hope they make the payments. So FHA is a great way to get somebody refinanced because they could lose their job and still do an FHA refund. The main thing is that you have to have a decent credit score, but FHA goes as low as 500. So it don't even gotta be that decent. So if they purchased a house and for whatever reason lost their job or whatever, but they have to still be making on-time payments on their mortgage, they can still refinance to lower their rate. And this other slide is dealing with an FHA construction loan. We talked about that already. So we'll keep it. Well, we talked about construction loans, but it's also eligible to be done on FHA. So we'll keep it going. And next up is Karen Foster. Give her a hand.
Good afternoon, everyone. My name is Karen Foster. I have been in the real estate industry for 28 years. I have been a loan officer for the last 5 years. I have a bachelor's degree in business admin. And my segment today is on P-loans and HELOCs.
That's fine.
Okay, so let's talk about.
Could you speak up a little bit?
Credit, which is a HELOC. It's a flexible loan that you can borrow against the equity in your home. It gives you cash to do whatever you want. It's your home, your equity.
Karen, I said speak up.
Oh, sorry. Thank you. Your home, your equity. It's similar to a credit card, but the interest rates are lower. You can use the money for educational expenses or building an ADU, whatever your, whatever you need to do with the money. And minimum FICO score is 640. Doesn't affect your first mortgage, so it is a second mortgage that's a lien against your property. Okay. Again, perfect for ADUs, perfect for renovations, and the draw period is 3 to 10 years. The repayment period is 10 to 30 years. And there's also an interest-only option for 5 to 10 years. Now let's talk about the loan, which is the home equity loan. It is a closed.
Give me 1 second, Karen. I'm so sorry.
Okay.
We're getting some.
So what's the current interest? It's gonna depend upon the current interest rate. It's the current interest rate roughly. It's gonna depend upon your income and assets. But there is minimal documentation.
Sorry, Karen. So I can't mic you up.
Okay, I'll speak louder if I'm talking too loud. How about now? Can you hear me?
It looks pretty good. Go ahead.
Okay. And next we have the loan, which is the home equity loan. It is a closed-end loan. It is a second mortgage, okay? And you receive a lump sum of cash from your home. Again, it doesn't affect your first mortgage. You can do whatever you choose with the money. It's your equity, your money, and there's no impact on first mortgage with that already. And you keep your existing mortgage.
Yes, ladies and gentlemen, you are here live in Inglewood, California.
All right.
All right, go ahead.
Do we have any questions?
I didn't hear you. No, please.
Oh, it wasn't. Okay, one is like a revolving loan, the home equity line of credit. And the HELOC is a lump sum of money, so it's a fixed. Okay. And next slide, please. We'll talk about our general programs, which is refinance, cash out, return. And we also have the high balance loan for FHA conventional and the financing for your luxury buyers, your high-end clients.
Real quick, I want to take us back real quick, Karen.
Okay.
Because I think that when we talk about home equity loans a lot, realtors kind of tune out. But in a lot of cases, we can use home equity lines of credit to help borrowers get the money for down payment and closing costs to upgrade buy. I'm not sure how you guys felt. You guys felt the energy earlier this year when there wasn't a war and rates were starting to go down. Anybody feel that?
Yeah.
I mean, my phone started blowing up a little bit more than usual. So, what that says to me is people are waiting, right? People are waiting on these rates to go down. As soon as the discussion of rates will start to go down, people start putting in applications, okay? But the people who are upgrade buying are probably the most rate conscious, right? Because they probably got a 2%, 3% interest rate. Rates have to make sense for them to upgrade buy. They don't want to refinance at first, but they need money in their equity. So they need a home equity line of credit or a home equity loan, pull out the equity from the property, use that to purchase the next one. And they're still going to be in a cheaper payment than if they were refinancing the entire thing to pull out cash. So just keep in mind, Ken actually reminded me to mention we do have a product that does it within 5 days. So I haven't actually used that product, but Ken's been doing them left and right. So we can get the cash to your client very quickly so they can move on with the next phase, which is purchase.
Just to piggyback, so the HELOC is a really good program. You can do it in 5 days, all automated. No appraisal, no title, no escrow. It's all automated. It works extremely well. So think of your clients, think of yourself and your family and friends. People are using HELOCs to add ADUs to the back of their house, pay off medical bills, high interest credit cards, and sometimes it's a bridge loan, just to allow them to go and make the next purchase because they're stuck with the property they can't sell. But they need 200,000, 100,000 right now to make that deal happen that they're trying to buy. So it really comes to play. In this particular source we have, the HELOC can go in second or third position. Almost nobody's doing third. Nobody's doing third. So it's unheard of. So yeah, you won't have to pay off your second or your first. As long as you got the equity, you do have to have a minimum FICO score of 640. Is you got the equity and you got the income. They do it on the PLAID system. If you all haven't heard of that system, PLAID. A lot of banks and fintech companies are using the PLAID system. They do a soft pull on you, on your client, and in seconds they can tell you exactly how much money they're going to send to you. So I've done these and gotten people $400,000, $500,000 in 1 week, and they couldn't believe it. So it's real.
What kind of documentation is there?
None. It's a no documentation loan. That's what's so beautiful. That's why they close it in 5 days. So they're not stupid. What they do with the PLAID system goes in and checks the metrics on your bank account. When they give you the offer, Craig, you're going to have to link up your bank account to your application. And in 30 seconds, they can see exactly how much money you got coming to your account and if you can afford to pay it. And that's how they make that determination.
No check stuff.
No check stuff, zero paperwork. And they do a virtual closing too, e-signing. So you don't have to go anywhere either. When it's time to sign your loan docs, you go on the screen and you show them your ID, answer about 2 or 3 questions, and you're done with your loan, what you're signing in about 30 seconds.
So this works well for someone who has a shared income and still working after seniors.
This works well for anyone that's got a lot of equity and they've got decent credit, 640, and you don't have to have a lot of income. If you're not trying to get a lot of money, let's just say you're just trying to get 80,000 or 100,000. You may only just need to show the plan needs to be to verify maybe $40,000, $50,000. So what you have to do is just contact me if you're interested, and they'll put it in the system. And they'll tell you in seconds. They can. Yeah, it really is helping a lot of people.
Is it primary only?
No, good question. So they'll go up to 90% on primary residence, up to 500,000, and then they'll go and on investment properties up to 80%. 80%.
You said 90% primary.
90%
You
primary,
said something else.
and up to 80%.
No. On the primary, you said something.
On the primary, I said up to 90%, and they'll go in second or third position. Second or third. And on investment properties, they go up to 80%. Close in 5 days. I closed one, the shortest I've done is 5 days because the guy responded. You just have to check your email every day and answer the couple of questions they ask you. So this is really good. And then you can add as many accounts to this to get yourself approved.
Oh, you said maximum, what was the maximum loan like?
500,000 is the maximum loan amount.
So this to be clear, all the programs we're talking about today is offered by anybody on the team, okay? But Ken has just been knocked out of the park with that, so he knows all of the details to that program for sure. But I want to keep us going, and it does sound like we got some interest in this 5-day HELOC.
Yes.
Ken, I was telling Ken, I don't know if realtors are going to want to know, and look at you.
Realtors call me all the time, man, and they do this loan for.
Right. Sorry. Okay. Okay. I wanted to bring up Dewan Glenn, y'all. So he's the next officer presenting. Come on, Dewan.
Good afternoon, everyone. I am the incomparable. Team Dewan Glenn. Been in the business for over 25 years, now over 30. I keep myself young with that way. All right. Started in the mortgage industry back east in Miami. And of course, I migrated out west, right? Go west, young man, go west. And have been here ever since 2000, right? Of course, my specialty, of course, are the VA home loans. So I'm going to go ahead and speak to you in reference to the VA home loans, and I may come back and touch on the actual jumbo loans, right? Now, first and foremost, VA home loans, very good. You need very low FICO, right? Dare I say 580, and they can do practically everything in 580. They also look for the client to have their what we call your certificate of eligibility, right? That means where you went into the service and you did actually 90 to 100 days of active duty service, and then that will allow you to take advantage of the VA home loan products, right? Of course, the VA, they have everything from cash out refinance, right? A lot of people, for some reason, they may have purchased their loan outside of VA, right? But they're easily able to come back, right? And take that mortgage loan and convert it over into your VA home loan products. And everyone knows the VA home loan products carries with it a much lower interest rates, right? Sort of rates are comparable to what FHAs are, but the most important thing about the VA home loan is you don't have your mortgage insurance, right? So that's an added bonus, especially out here in the high cost areas such as Southern California. Right? That can easily save you $300, $400, sometimes $500 a month on a mortgage payment. All right. Again, the great thing, another thing with the VA home loan purchase, everyone knows it's 100%. That's no money down, right? The only money that you have to put into is, of course, your earnest money deposit. Right? Earnest money deposit is basically what you have to show to go along with your purchase contract to be considered an actual bona fide offer and / contract.
Can you touch on units?
Units. One great thing in reference to the VA home loans is they don't have what we call your that self-sufficiency test that FHA has. You do not have that in VA home loans. With units, you can go up to 40 units, right? Obviously, you have to occupy the property initially. One thing that we always say when I'm talking to VA looking to be home owners, I always suggest to them to go into units first, right? Because the reason why, one of the biggest items when purchasing a home or looking to purchase another home is it has to be like a move up, right? So you can't go from a single family into a units, into a duplex, triplex, fourplex, right? Because there's no benefit for that underwriter to say he's moving up, right? But you can get into that investment if you were to purchase the 4 units first, 3 units first, or duplex first. Then you can come back and says, hey, I don't want to live close to my tenants at that point. Then you can easily move up into another single family residence, right? Still,
100% financed, right? You would have to come back and bring yourself out of the current VA home loan, right? And then it restores your eligibility, and therefore you can come back and go with that 100% financing all over again. Right? A lot of veterans use this as a stepping stone, getting into their investment type portfolio, right? So it's an excellent tool for that.
I have a question.
Yes.
At what point they require that person buying units has some property management experience? The veteran, is that still the case?
Not necessarily, right? Because we can also give the client that investment know-how or knowledge before. It could be as simple as I used to take payments for my parents when they had a home, they were renting a home or they were buying a home. So it's easily shall I say surmountable. The whole issue of needing some type of experience.
You can also use a property management company that say they're gonna have that in place at closing to get around it.
Yeah.
So another item with regards to the VA home loan that's very beneficial to our veterans. Let's say, for instance, they do buy a fourplex and so forth, and usually they may have a slightly higher rate than most, right? The VA has what they call the VA HRO, which is the interest rate reduction refinance loan. What that says is you just have to be in a VA loan for I would say under 7 months, right? Have to make 6 on-time payments. You can actually refinance that loan with no documentation, right? No appraisal needed, no income needed, right? It's just to give you a lower interest rate. The main pre-qualification is that it has to be a benefit, obviously, to the buyer, right? And you have to save at least a 0.5% on your rate, right? If your rate is, let's say, 7%, if you're going to a 6.5, that's doable, right? We like that, right? Obviously, if you're going lower than that, that knocks it out the park and it gives you that much more benefit to the homeowner.
Yeah, before we continue, any questions about VA loans?
Question, Duane, the VA loan, so is that just for refinancing or is that purchase?
The loan is only for refinancing.
Okay, is that purchasing?
Interest rate reduction, refinance loan.
Gotcha.
Okay. Yes. And anyone else that's looking at us through Zoom, if you have any questions, please jot them down and Carlton and I can definitely come back and go and give you that clarification.
I have a question.
Yes.
No, we moved on. Okay, go ahead.
Go ahead.
So who's allowed to be on the loan? Is it married, unmarried?
Right. One of the big things with VA home loans is usually only the veteran and spouse, right? But now there's also another type of VA loan where the children, if you will, of the veteran can come into the loan, right? And depending on if that's the case, what means that we may have to take it to a different investor, right? Most of our investors only like to do the regular VA loan was the spouse and the veteran. But you tend to lose out in a situation to where, let's say, a daughter wants to buy a property with father or mother that was the veteran. What it does, it basically cuts the entitlement in half. Let's say, for instance, you purchase a home for $500,000. VA would only guarantee the veteran, and they would split it in half, $250,000. So the other borrower, there will then be a requirement that they would have to come in with at least 10%, right? 10% of that second part, that's 250,000. They would have to come in with 25,000.
That's something like 5%.
Yeah, and it basically turns into like I said down where FHA would be more buying.
What
about closing costs?
Live in the property?
Yes.
So they won't accept a non-occupied car?
No.
Okay.
What about closing costs, Damon? What about closing costs?
Both of them have to live in the property.
Yes. They both, it's not a non-owner occupying type situation on the VA. They both need occupied property. Yes.
I'm sorry, Glenn, were you saying something?
I was asking about closing costs. That scenario,
I think we may have.
because with veterans, I noticed they don't have to pay
Glenn,
closing
I'm
costs,
sorry,
so
hold
in
on one
that
second, bro, I
scenario,
can barely hear you.
can you hear me?
We want you doing it. There's no limit to VA, no, either.
Actually, there's no limits, even though we're in a high cost area in Southern California, let's say we're in Hawaii. Same thing, right? The only thing that they require you is that, we get what we call an approved eligible. Meaning, now if your income would support the new loan, all day, every day. Yeah, as a matter of fact, I'm doing a refi right now. Client has a DTI of 52%. And that's front and back.
Yeah.
That's front and back. She's paying off all of her bills and cashing out quite a bit of money.
Yeah, I've got one right now, they're going up to 55%.
55%, right? I've seen a VA, I've done a VA refi now and purchase where their back end DTI is actually 72%.
Oh my goodness.
Right? And all day long, they have what they call is a residual test, right? If the client has enough residual income after they pay their mortgage and with other bills, if their residual income is, I've seen the most like $1,500. That's the maximum amount of residual income, and that's what the household is about five people in. Residual income is for the most part based upon the number of people that are living in the property. Right? So if that residual, if they meet guidelines with regards to the residual back end, they're good to go.
Quick question, and I apologize, guys, because I'm having some tech issues over here with putting the speaker on. But Gwen Allen asked, what about closing costs for VA and child buying a home?
When you say child buying a home, Gwen, I think
No, I meant you had a scenario regarding the VA
yes,
or the father or whoever is the military person and their child buying
Yes.
together. The
yes.
child would have to come in with the 25% down, but is there any closing costs in that scenario?
No, we're going to separate the two. We're talking down payment, but you will have your customary and usual closing costs. Now, if the
Okay,
seller
all
is
right.
contributing for that closing costs, by all means. But that down payment is basically the VA guidelines when they're bringing in a non-veteran in with
Right.
an actual veteran.
Okay.
All right?
Okay, thank you.
No sweat, anytime.
Cool, we can hear you guys now, so I apologize for that. Couldn't hear you this whole time. All right, so we're gonna keep it pushing.
Mhm. All right, now we're gonna talk about jumbo loans, right? And I'm gonna do a lot of attorney on this one. Jumbo loans, of course, even though LA is considered a high cost area, we consider jumbo loans as anything over what 1.2 million. As far as the amount being financed. The amount is over 1.2, it's considered those to be jumbo loans. Right. Of course, primary residence only. 90% LTV, meaning if the property costs 1.2, 90, they can go up to 90% financing. Usually once you go above that, usually they will require you more close to like 15 to 20% down. 680 minimum FICO score. Once we start talking about higher loan amounts, we're looking at a higher FICO scores. Right? Loan amounts we can go all the way up to 3.5 billion. And depending on the situation, we can go with sometimes with some non-QM products, go even higher than that. With jumbo loans, they're always looking at reserves, right? So you want to be ready to be able to show reserves. And it's usually about 6 months reserves. Another benefit to jumbo loans is that there's no mortgage insurance, right? So where that high loan amount with the high loan amounts, let's say 1 million, if you're doing conventional, you may definitely see that you have mortgage insurance. But if you go a tad bit higher than that, the great thing with jumbo loans, you won't have any mortgage insurance. Of course, 1 to 4 units, they go all the way up to 1 to 4 units. Right? Primary residence and second properties only, as well as investments. Usually, when we're looking at the jumbo loans, if it's conventional, most of the time we're only looking for 1 year tax returns. We don't need to see 2 year tax returns, right? And a lot of these we incorporate with one of our main investors, right? And they're able to use that 1 year tax returns, get that loan in and out rather quickly.
Okay.
Right?
Any more questions for Devon?
On the jumbo loan.
Also high interest rate?
No, actually. Well, shall I say, we say that they're comparable to what your normal conventional rates would be. Yes, yes. So,
And the more
anything
down,
else?
and the more down, the better when it comes to jumbo.
Yeah,
Because we could do a 10% down jumbo, but the rates
your
gonna be
rates would be
higher.
slightly higher.
And in some cases, you could do an 80-10-10
80-10.
and not get into a
Yeah,
jumbo
right.
loan.
Mhm.
Because there's certain things that a conventional loan will do, the jumbo loan won't do. Gotta figure that part
To
out.
where if you basically put them side by side, you can do more or less a comparative and see which one is going to work best for you. Right? Yeah, it's all about options, right? And that's what we here at our mortgage want to give you guys. We want to give you options, right? There's always, as they say, more than one way to skin a cat. Right?
All right, thank you so much, Dewan. Ken Smith back up real quick. He has a little portion here while Ken's making the transition up here. Quick story that we just had a scenario where I had a client that was declined through a bank that we submitted them to. Okay. The good thing is us being a mortgage brokerage, we could switch from one bank to another without rerunning credit, without having to reorder an appraisal. We don't have to recondition. We don't have to restart an application. We went from one bank to another. And we got to clear the close today. So we talk about having options. We talk about having options. That's why you want to work with a mortgage broker. You never know what situation your client might run into. If they want to rent their 2-unit condo in Panorama City for $3,500, which is high for that area, that is their business. And who's to say that those rents aren't really $3,500? We had a bank that approved it. So I'm gonna kick it on over to Ken Smith, and we'll go from there.
You're Stacy. Where's that? Stacy.
Yeah, I'm Central. Okay, guys. So these programs we're going to talk about, these are great programs for self-employed people. If you got people who are self-employed, these programs are going to help them a lot. Because, there's a lot of people out here, as you know, that are self-employed, like most of us. A lot of us make a lot of money, but we can't show it. We're writing off everything. And if we don't think about it until that time comes for us to get financed. And then it becomes a problem because you can't show the income. So the programs that are going to fix that problem will be all of these programs. You got the bank statement program, which is really good. You're going to need a 680 FICO score. And they're going to usually want like your bank statements going back about 12 months. If it's personal bank statements, they'll accept 100% of your deposits. If it's a business bank statement, they will typically go 50%. How you get around the business bank statement, you want to basically have your CTAC or your CPA put together a letter stating that your business expenses are only 10%. If you get that from your tax preparer, they'll give you 90% of your business deposits. If you got a letter from your CTAC or your CPA stating that your business expenses are only 10%. But this is a really good program. You're going to typically need reserves of anywhere from 3 months to 12 months. You're going to have a down payment typically of at least about 10 to 15%. But it's a great one to go to. Bank statement program.
Any questions about these?
Yeah, and feel free to interrupt me if you have any questions. Because these programs are really good and there's a lot of nuances to it.
For those of you who have millionaire clients,
Exactly.
or $1 million in the bank, or even a large amount of money, asset depletion.
Right, go to that now for that. Asset depletion. Oh, I'm sorry, what's your question?
Statements. Are there any businesses that are not allowed?
No, they'll take all businesses. It's all about pots. It's all about, this program is designed for people who have great cash flow, they can show through their business accounts.
Even marijuana?
Cannabis.
Cannabis.
That's a good one. They'll probably take it. It's income, it's cash. So they don't have any limitations on where that income comes from. If you've got it coming in, they'll take it. That's the good one. If you got somebody, we talked about, let you know, I'll check. Because maybe they not, all may not take it, but you know, Trump just recently passed a law where he's putting the cannabis business, the marijuana business, another class, which is really helping that industry a lot. Okay, for the next one, depletion, asset depletion. You're gonna qualify with asset depletion based on your liquid assets. This is a program for people with a lot of money in their account, $500,000, $600,000, $700,000, but they may not have a lot of income. Well, the bank is going to look at your assets for $500,000, deplete it. They typically deplete it over 60 months. And over 60 months, and then they do a calculation, and based on how much liquid assets you have, they give you an income credit for that. If income credit, maybe you don't have to show us much income because of the asset depletion. So that's a really good program for people who are sitting on a lot of cash, but they may not make a lot of money. They can qualify with their liquid assets. That's the asset depletion program. Very flexible, great for self-employed people. You know, and this is the beauty. You don't have to use the money. You just have to be able to show it. They use it in the calculation. So it could be in your savings account. It could be in an investment account. They won't use it, but they'll use the calculation to help you qualify. Let's go back, Carlton, one more, please. So other one we'll talk briefly about is the 1099 program. Now, these are for basically people who just, you know, they're gig employees, they're independent contractors, real estate agents. In the 1099, you don't need to show anything. No tax returns, no paycheck stuff. You just qualify with your 1099. Great way to go for those folks. Next one.
Yeah, that's real estate agents too.
That's right. That's what I just mentioned. Real estate. You know, a lot of times, you know, that's it. That's all you guys are 1099s. They'll look at that, and as you can see, you know, you're gonna still need to have a FICO score and a certain level of down payment. Okay. Any questions, anyone?
Nothing on the chat. You can keep
So another one I don't see. If you go to next, do we have a P&L statement on here? Profit and loss?
but you could talk.
I'll talk about it. So P&L is another good one too. Now that is my fallback in all those fails, because if they don't have a lot of money in their bank account, they can't show a lot of cash flow coming through their bank account, we do a P&L statement. This is where we get to make up the income. You can't beat that. You get to make up. I got a guy alone recently, he got $600,000-$700,000, and he had a business that actually failed. He couldn't believe it, you know. But he had a property in Venice worth $4 million, and he had over $3 million equity in it. So he couldn't believe it. He said, do they know what we're doing? Yes, they know. So he got it. Based on, you just put the income together with a CPA, a CTAC, and they'll basically show the income you need to show to qualify for that loan. As long as you got the equity, as long as you got the credit, it'll happen.
Okay.
So you can see here at Monarch, if you got a pulse, we'll get you a loan. If you have a pulse, we'll make it happen.
What kind of place?
You do have to have at least a 660, 680. Okay, now the next one, debt service ratio. Now this DSCR is one of the most popular programs of all, because in this situation, you don't even have to have a job. All you need to have, the property has to qualify. The borrower doesn't have to qualify. If the property has the income, support itself, which is called a 1-to-1 ratio, it'll go through. So that's a really good one for people. And so, as I mentioned in one some of my other seminars, if you've ever gone to a party and you met somebody with about 10 properties, they're bragging about they got 90 doors, and they own 10, 11, 12, 13 properties, this is most likely the property, the loan they get on the loan with DSCR. Because all you need is basically find a good realtor that can help you find cash flow properties, income properties that got good income, and you come up with the 20%, 25% in this land. If the income is there.
Sorry, Kim.
Sure.
Finish with yours.
You got a question?
No, yeah, he had a question about if you could explain what DSCR is.
No, this, I just don't know what it includes.
Oh, okay. Oh, sorry. So that's what happens when you play telephone. You get the
Okay, DSCR stands for debt service coverage ratio. So it's basically a program where a borrower can buy a property. You can't live in it. It's for investment properties, and you're qualifying for the property based on the income of the property. It's not based on you. You may not even have a job. You find a property is a 4 units and it's got great cash flow, and that cash flow can pay equal for PITI, the principal, interest, tax, insurance, you're good. That's what it is. So yeah, so that's a real popular one, is well used. That's probably the most used of all these programs because it's so easy to qualify for. The next one, anybody questions by DSCR? And by the way, when they go and they look at the income, they're going to look at what the current rent is. They're going to take the lowest of the two typically. So what the owner is currently getting on the rent and what's on the 10 of the appraisal, the 1008 application, what's on the rental survey. And whichever one is the lowest is what the appraiser is going to take, and they're going to use that to qualify in the DSCR case. Okay, there you go.
I just want to add that sometimes with DSCR, because we have multiple banks, there are some that have one that took the lease and did not take the 1007. Right, so like we have some flexibility.
Because some lenders, they got little overlays, they got other little overlays where they'll do things a little bit different. So yeah, you may find one like that. And like some there's even a DSCR where it doesn't even have to be a 1-to-1 ratio. I've got a few, it could be a 0.75 to 1 ratio. So even if the rents aren't even covering the PITI 100%, if it's at least covering it by 75%, it'll approve. So that's a really good one. The next is hard money.
Oh, my bad.
I'll talk about that briefly. So we got hard money loans. These are some really good programs for people who got horrible credit, but they got a lot of equity. They got a lot of equity in property. So I come across people come to me, oh, my mom, my dad, my grandparents left me this property. It was $700,000. Nothing's owed on it, but my FICO score is 450. Can I get a loan? Yes, you can get a loan. So these hard money loans are they're asset-based loans. It's not so much based on the credit. It's not based on the person's income. They may not even have any income. It's all asset-based, based on the asset. The asset will make it happen. So that's a really good one. We have multiple sources. If you come to us, we can make it happen for you. And then the last I'm going to take briefly is called, one second, Carl.
Oh, I'm sorry.
The last one is called a no income required loan. Now, the no income requirement loan is really close to like a DSCR. Literally no income is being put on there. Nothing, no documentation, no calculation, no DTI. You just have to have 25 to 30% you can put down. You got to have a FICO score of at least 660. And usually typically at least 3 months reserve. And that will happen. That's another one. That's on the order of a DSCR. The bar is very low. Thank you.
Yeah, so far on those, any additional questions about those three?
3 months reserve, cash in the account.
Yeah, exactly. So if your payment is $6,000 a month, you need to have at least $18,000 in your account, because it could be in it could be any kind of, it could be an investment account. It doesn't have to be in your checking or savings account, but you have to have that 3 months reserve. They want to make sure you're not completely broke when you close the deal, that you do have some cushion, some of 3 months reserve.
All right. So Ken, I think I'm gonna just jump over this one here. Talk about cross collateralization. And guys, if you guys have any questions about any programs that's on the screen, speak up and just ask, because I want to make sure that we have enough time to close this out. We didn't really tell you guys it's probably gonna be a 2-hour meeting, but we're approaching that. So Ken, if you don't mind talking about.
Yeah, cross collateralization is just like what it said. You use equity from another property to secure financing somewhere else. So they're going to cross collateralize. You want to finance this property. Okay, but I've got, I want to buy this property over here, but I got this house over here, the property over here that, I have an LTV, I have a loan to value on it only 20% or 10%. So you got a lot of equity in it. They'll use that other property to cross collateralize to help you buy the new place. So a lot of people use that strategy, and a lot of times when they have multiple properties. And then you got the high balance loan, designed for high cost areas and large loan amounts. And they can go on primary homes, fixed loans, and so forth. Fixed and arms, you got a fixed rate, or you got an arm if you want. And then this other one, I-10 loan. It's basically for people, ownership for people without a social security number. If you don't have a social security number, the mortgage option for the borrower is using their ITIN. And you can use that instead of a social security. A lot of foreign nationals have that, and undocumented, other folks.
Let's just jump straight to reverse mortgage on this, because we covered obviously you might not even know it, but we talked about a few first-time home buyer programs, including down payment assistance already. So talk about reverse. then we'll go from there.
Yes. Reverse mortgage is a really booming product. And a lot of people, they come out with some new proprietary products that are helping a lot of folks. So reverse mortgage is really good for your folks that are over 62 years of age. You got a lot of people out here over 62. They live in their home and they're retired, but they're cash strapped. They really don't have money to live off of. But they're sitting on their house is half paid off or almost paid off. Reverse mortgage is the answer. Reverse mortgage is going to change your whole lifestyle. It's going to fund their retirement years. I've had people come to me do reverse mortgage for all kinds of things. A real common one is they'll take a reverse mortgage and the cash and they'll use to build an ADU in the back. And now they got $3,000, $3,500, $4,000 a month coming to them. That helps fund their retirement years. They've increased the value of the structure of the property. They're getting the income that's coming in every day. It's a win-win. So reverse mortgages are really good. Some people do it to pay off debt, pay off medical bills. It's all kinds of things. You just have to be able to stay in the house for at least 6 months. You have to live there for 6 months. You have to keep the property taxes up and the insurance up. You have to have residual income of at least $600-700 a month. Meaning once you pay off your mortgage, you pay off all your expenses, you still have to have $600-700 a month left over. And you got to have a FICO score of at least 600. 600 is the beginning of reverse mortgage. Now, the reverse mortgage, the traditional one you all know about, that's the harder one. Most people can't qualify for that because they don't have their house paid off. If they can't qualify for the traditional reverse mortgage, which pays off that first and makes that the first loan reverse, there's a new product called reverse mortgage second. And that's a lot easier to qualify for. So your first stays in place, the owner still will continue to make that payment on the first, but they'll give you $200,000, $300,000, $400,000, $500,000 in second position if you got the equity. So a lot. Pardon me? Say the last thing you just said. They'll give you $200,000, $300,000, $400,000, $500,000 in second position if you got the equity. That's reverse mortgage second if you can't do the first. So a lot of people I come to me, they can't qualify for it first because they're too young and they don't have enough equity. So the numbers don't come out. But what they can do is do a reverse mortgage second. They'll qualify for a second that gives them $200,000, $300,000, $150,000. So something's better than nothing. They opt for that if they can't get the regular reverse mortgage. So that's a really good one. And it's a proprietary product.
You mentioned they must live in the property for at least.
They have to live in the property for 6 months at least.
Of the year.
Of the year, yeah. So
Every year. You said
every year, yeah.
it's
Minimum, yeah. They have no really way to check on it, but that's the rule. So if you decide you want to buy another house in the Caribbean, you can go to the Caribbean and be in the Caribbean during the winter months and come back and be here the other months. But you have to stay in the property, and they consider you living in the property if you're there for at least 6 months.
At least 6 months.
And as long as you always kept your payments up, your property taxes and your insurance, they won't do what's called a LISA. LISA is LESA. It stands for Lender Expense Set Aside. And so what they do is if you ever get behind on your property taxes or you get behind on your insurance, they're going to take all the money, they're going to calculate and figure out your life expectancy, and they'll do the reverse mortgage, but they're going to set aside money to pay your property taxes and your insurance for the rest of your life. Because they want to make sure that gets paid if you have any history of not paying that on time.
But they want you to at least make at least what, $3,500 a month?
No. Remember, residual income is only $600-700 a month. So let's just say if all your bills are coming to be $2,500 a month, let's use a simple number, $2,500. Let's use a simple number, $3,000. All your bills, all your credit card bills, your where you're paying to live is costing you $3,000 a month. You need to have at least show that you're making at least $3,600 a month. Because you need to have that residual income left over, at least $600-700 of discretionary income left over once you pay all your bills.
Yeah.
So they got the bar really low. You don't have to make a lot of money for these reverse mortgages. As long as you got $600-700 of residual income, you're good. Any question?
All right, we're gonna wrap it up right there with Ken. So everybody give it right here.
Okay.
So I'm trying to get us through the closing, y'all. And those of you, I hope you're eating lunch at home. All right, guys. So we're kind of shifting from programs to things that we do here at Monarch that you really can't get other places. The first thing is a co-branded realtor portal. Okay. So with our software, it's called Arrive. We're able to give you access to your leads to help you accomplish a few things, right? So you ever send a lead to a bank and you're asking, hey, what happened with that lead? Well, the portal, you log in and you can view what's happening with that lead. If you ever get a client pre-approved and you want to modify the pre-approval letter, you want to take the $800,000 pre-approval letter and make it 675. You can log into the software and make the changes yourself. Okay, so it really helps the realtor, and it's also co-branded. So if you wanted to send somebody a link and you're working with somebody here at Monarch, you will appear kind of similar to this at the top, the loan officer at the bottom. It's just a cleaner experience and more of a proper handoff, because sometimes people struggle with that. If you have a client and you're like, hey, talk to my lender, but you could give them the link if you like. I personally prefer to speak with them first, but just know that it exists, that you can actually give somebody your co-branded link to work with a scope at the same time. The other thing here is going to be that we offer realtor partners, okay? So we are becoming better at print marketing, okay? So what that basically means, that's going in on, okay. What that basically means is that if you have a realtor, you have an open house, you want to get some flyers made, we have up to 20 templates you could choose from. So we actually blasted this out, and it'll be coming out through other LOCR pretty soon, where you could just pick a number. Hey, I want template number 17, give us an address, we'll make you an open house flyer. And if you're able to pick it up here at the office here in Inglewood, we'll even cover the cost of printing it for you so that you have co-branded flyers for your open houses, okay? Give us at least 1 to 2 days notice, and you do have to email info@Monarch Mortgage. I'm not building these myself. I have assistants that help with this type of stuff, so it goes to them. They'll be in touch with you if you want to make any changes, but you have to use that email address in order for it to kind of kick off. Within 1 to 2 days, I'll have the flyer designed for you. I can print them out in 5 minutes, so it's not that big of a deal. Just let us know when you want to stop by. Okay? Co-branded marketing. So beyond just doing the standard cookie cutter flyers, we can really make a flyer however you want. Today's AI and stuff like that, you can build a flyer relatively quickly, whatever you wanted to say on it, throw you on it, throw me on it, throw whoever on it, and get it out to the market, right? So I got Clarence Johnson up here, even though he can smile more in his pictures. And just as an example, right? A just closed flyer, Ken closed, just closed, Dewan closed, just closed. So, we could throw something like this together for you guys pretty quickly for your own closings, and also make it co-branded if needed in some cases. And social media marketing, okay? Which I don't know if you guys know this, but we can put you anywhere in the country with this green screen, okay? So this particular green screen creates a background. It could be whatever you want. So Clarence on this video is talking right here in my office, but he looks like he's somewhere else. And so is Michael Allen. So if you guys are interested, Monarch does offer the ability to help you with your social media marketing. I would recommend, if you want to take advantage of this, coming by early, like 9 a.m. in the morning, make a reservation with us. I want to come and record some stuff. We'll kind of block out some time just to help you record your footage. I have a social media manager. She's out in the Philippines, virtual assistant. We send her your footage. She edits it, sends it back to you to post on your social media. Social media is becoming the biggest way to generate business, bigger than door knocking, bigger than cold calling, bigger than basically anything we've historically done to build business in real estate. So we're here to help you with that, okay? We're not going to watch Michael Allen's video. This is just an example of us doing King Talk, things like that as well, which we recorded here in the office. My team members out here are led. Ken out here getting it with some of their marketing, okay? So we're able to get you out there. For those of you who are on the listing side, you don't deal with buyers too much, but you do a lot of listings. But we had to figure out a way to try to help you guys out. So we're looking at doing every door direct mail for your just close, right? You just close a property, you want that neighborhood to know you just closed. So instead of you door knocking the area, we're going to have the U.S. Postal Service do every door direct mail and drop off flyers of your just closed home to market you to help them with if they want to sell, right? So typically up to about 500 flyers, typically one zip code. After the closing, we can make that happen for you. All right. Beyond that, let's skip here. We are doing home buyer seminars. We actually have one coming up. I'm going to show you the flyer at the end of next month. Okay. Home buyer seminars are like, is anybody doing them anymore? I can't remember the last time I seen anybody else do a home buyer seminar, but they're still needed. Home buyers still need to understand mortgages. They need to understand what all goes into buying it. They need a resource to go to just to talk about that sort of thing. The ideal first step is you, right? So they come to you, and we are setting aside home buyer seminars that are just the loan officers presenting, because we don't want your client to get stolen. We're just talking to them about what the loan is all about, all that sort of stuff, and then the rest of the details is on you. Okay. Now this is something I want to talk about that's near and dear to my heart, because we started championing it. We went to Detroit, Michigan, Pontiac, Michigan, and it occurred to me our realtor partners did not know we can close loans in 14 days. I would feel like I'm lying to you if I just said it out loud. So I brought in a special guest, Clarence Johnson. Clarence, how many? Actually, I didn't bring him in. He had no clue I was going to throw on a bus like that. But how many have you done in less than 14 days?
I'm thinking 2, 3.
Yeah, two.
But it's very competitive when people see that on the other end, they don't even believe it. I didn't believe it.
Yeah. Clarence called me with a scenario and said, we need to close this loan in 10 days, or else the house is going to be lost to foreclosure. And we closed it in 10 days. We closed it so quick, the seller wasn't ready to close, right? So we ended up in a situation, we ended up waiting on the seller because we had 10 days and we met it, but the seller wasn't ready. So they were scrambling so we could meet the thing. So how do you close in 14 days? First thing, work with Monarch Mortgage. Anybody here you see loan officers, I suggest you work with them, okay? Number 2, get your parties on the same page, because the seller needs to be aware we can do it. Your escrow, we need fees quickly. Your buyer, we're going to need stuff in 1 day, right? So we send you conditions. We need all those conditions back in 24 hours. If we do that, order the appraisal on a rush, because some of these appraisals could take almost 2 weeks by itself. But order the appraisal on a rush, and we have it back within 4 days. Get a verification of employment back, really at the beginning of the process. And our ace in the hole, CD at initial. So those of you who have been closing transactions know that you have to have a closing disclosure out 3 days before the borrower can sign loan docs. If we have, through one of our banks, we are getting the CD out at the initial underwrite. That expedites and compresses the process. So we almost save an entire week almost with that process by itself. As long as we have a homeowner's insurance quote, we could pull off having the CD out at the initial underwrite, and that puts us in a position where we're closing in 14 days. So I have a loan that just started. Today is Thursday. It started on Tuesday, and it's a 14-day close. So if you guys want to see if we made that happen, the Nettles family will be in a home come May 11th, okay? And it started on Tuesday. So proving to you we can get this stuff done, all right? Right. So let's see here. Oh, and by the way, the reason why she's in escrow, it was not because of price. It was because we could close in 14 days. So it actually beat out other offers, not because of the price, but because of the speed, right? And then, of course, satisfying conditions within 1 to 2 days. So about your client, I talked to my team about this. We had a whole meeting, and we wanted to make sure that when we talk to our realtor partners, that we do have an expectation in our partnership, okay? One of the things is that you need to know a little bit about your client, okay? How much your client makes. Does your client have good credit? You don't need to know the score. You don't need to pull credit report. Just have the conversation. You know, do they have a 580? Do they have a 700? Well, what do you think your credit score is? Is it good? Is it bad, right? Does your client have enough funds for the down payment and closing costs? Now, I know some of you guys might feel like Oh, that's a lender question. Here's what's happening. You guys send us a client, and it almost makes us look bad that you sent us a client that made $20 an hour, didn't have no money in the bank. The client wasn't going nowhere. We wasted our time, you wasted your time, and it should have stopped with you, right? When you knew the client made $20 an hour and had no money saved, you should have told them, well, you're going to have to save some money, and you might have to make a little bit more money, and or where you're moving to, right? If you're moving to a market where you can afford that at $20 an hour, different thing. But I don't even think you can afford anything in California making $20 an hour, to be honest with you. So know a little bit about your client, because we don't want to waste your time. We ain't trying to make you look bad. We're not trying to spend our days declining people. If you make too little to qualify in California, you have to have an idea of what that kind of looks like for the area. Okay, so you're buying in Inglewood, you're gonna have to make over $100,000. You're going to Lancaster, Palmdale, you might be able to get by with 50, but you got to keep in mind what the person is looking to achieve. Okay?
And a good point he's making, just to add to it, before you turn that client away completely, if they come to you and they don't have very much money, they only make $20 an hour, ask them, do you have co-borrowers? Do you have relatives that are willing to come in with you? Because I have done deals before where everybody made about $20, $25 an hour. They're a Hispanic family, but it was 4 of them, and they made it happen. So
that is true, because we're talking about the income on an application of all parties on the application, right? So say somebody has to make over $100,000. Well, one person doesn't. This person makes 60,000. Right. Well, there's a husband and wife, they both make 60. Well, now we're talking $120,000. But you need to know that about the client. Like, how can we get to the point where you guys can afford a home? Okay. So that way we're not declining people left and right. Now, how we save your clients money, we're offering a match or beat. Ken mentioned it earlier. What we're basically doing is, if we get a loan estimate that your client received from another bank, we don't want you just saying, oh, we'll go with them then, right? So we want the opportunity to match or beat. We're going to give that loan estimate to the banks we're working with and basically have them compete for the client's business so that you don't lose and we don't lose our partnership. So we're doing match or beat. It needs to be a real loan estimate. I've seen some fake stuff. And if that's the case, we're looking to match or beat their pricing, okay? Now, in most cases, you're not going to have to worry about match or beating, because we're beating 80% of our competition already, okay? But that other 20% we might run into, yeah, we can match or beat them too. Buying a home with an appraisal credit. So right now, through the month of May, we are offering a $600 appraisal credit. So that's something you can use to tell your clients about. If they're looking to purchase and they're considering different banks, well, we'll cover up to $600 of their appraisal. Okay, so and they can see that credit at closing. It's a credit, it's not a free appraisal. There is a difference, meaning the client has to pay for it, but they'll get credited at the end of the transaction. Okay, we have to do it that way, or else we might just be out money if they didn't buy the house, right? So they have to buy the house and they'll get the credit. And so just to let you know, we are offering those things. And some of the things that we are doing that a lot of banks are not doing. If somebody purchases a condo, typically the buyer has to pay for the condo documents. We have a lender with us that'll help cover the cost of condo documents. Condo documents are ranging from $300 to $1,200 nowadays. So it's not a small amount of money. This is a good, sizable amount of money they have to spend just to get a condo questionnaire, the budget, all that kind of stuff that we need to make sure we can lend on a condo. The buyer's responsible for it. We're covering it. Reduced locks on 14 days. So because we're closing so quickly, we don't need a 30-day lock. The longer the lock, the more expensive the points are. So we compress that to half. We're actually able to save the client's money that way. We're doing discounts on refinances. So we want clients for life. So you do a purchase through us, we want to refinance that client and offer them a discount to do the refinance with us, right? And of course, the match or beat program. So just on this screen alone, working with us can save your client an estimated $2,000. Just looking at the appraisal credit, the condo documents, the reduced cost for a lock. I just took somebody from a 30-day lock to a 15-day lock, and it was $900 less. So speed is leading to discounts, right? So just know that. How we help you win. Accurate pre-approvals, all right? One of the things I built my career on, and my team is right in there with me, is making sure when you guys go out with a pre-approval, that you can treat that pre-approval like it's cash. Okay? If you give that pre-approval to somebody and they close or they accept the offer more so, then we'll be able to close that transaction. Okay, so we're serious up front about the pre-approvals being accurate. Social media marketing, we mentioned that. Co-branded marketing. Every door direct mail for listing agents. By the way, the listing agent, you need to list us as a preferred partner, right? On your what is it? What's it called? MLS, but
Agent remarks.
Agent remarks. Thank you. On the agent remarks. Printed flyers. So if you guys need anything printed, open house support. We are out in the community, shaking hands, kissing babies. If you guys need us for your open house, we're available for that as well. Home buyer seminars, whether it's just you wanting to put together one with us, or you or your whole brokerage, or you just want to refer somebody who needs the information, we're doing home buyer seminars. And of course, here in Inglewood, California, you have local office support. So if you need to have a buyer's consultation or a listing appointment, and for some reason you don't have a place to meet, feel free to use us because that's what we're here for, okay? We have a home buyer seminar coming up May 30th. On Saturday. Once again, this is just being presented by my team, so there's no other realtor competition to happen here. Our goal is to make sure they know about their loan options. They understand how loans work. They understand what's included with their monthly payment. They understand, hey, what if I don't make? They have an avenue to ask questions. What happens if the market goes down? What happens if it crashes? What happens if I don't make the payments? What happens if I don't make payments for 3 months? What happens if what's the cost that I have to anticipate going into a house? All of those different types of questions of what is covered during a home buyer seminar. We have one going on Saturday, May 30th. All right. And
Is it strictly Zoom or is it hybrid?
this one is going to be on Zoom. Because honestly, the last one we did, I think we had 15 people or something like that on Zoom and 2 people in person. And the 2 people that were in person were very awkward. So I was like, you know what? We don't go to Zoom so people can just relax in their home Saturday morning, tune in, get the home buyer seminar, go on about their day, their weekend, and it's very less intrusive. People don't have to get dressed up, come to the office, do all that kind of stuff. And so we're looking at Zoom for now. We probably can consider and will consider in-person home buyer seminars in the future. Right now, we're just not seeing people show up for the in-person stuff like they used to.
You can send us that digital flyer, we can forward it to our clients.
Absolutely. Yeah, but I'm glad you said that because any flyer you see offered by Monarch Mortgage, if you want the flyer, just let us know. Hey, can you take this and throw my photo on it? If it has terms that are like loan specific, then it has to have a loan officer on there, right? Because they have to have an NMLS number to talk about loan stuff, so it has to be co-branded. But if there's something that's not, I think we just did a flyer for was it 14-day close that we did with you on it, Janice?
Not me.
No, was it? No, we sent you a flyer.
No,
No?
you sent me one regarding.
Appraisal credit.
Yeah.
The appraisal credit.
Right.
So the appraisal credit, technically it probably should have been co-branded. But point being, there's stuff that we can do co-branded and there's stuff we can just do just for you to help advertise yourself.
Yes. So this one you could do my picture.
Yeah. We just delete all these speakers and just put it as you. So obviously we do want to let them see that, there's going to be some people who, but yeah, we could definitely find a place to put you on a flyer, your contact information, advertise it as something that you're promoting and make sure the client is returned to you after the summer.
How do I make the request?
info@monarchusmortgage.com. Anything related to anything like flyers, open house flyers, social media, info@monarchusmortgage.com.
So I have an open house on Sunday, and if I wanted to get co-branded, is that enough time?
On Sunday, today's Thursday.
I have
Yes,
to
that's
start.
enough time.
You have my son. Saturday is enough time.
Not time.
It's enough time.
2 days.
So they're asking me, guys, if it's enough time. They tell me today I have an open house on Saturday. Yes, it's enough time. We just asked for 1 to 2 days. So today's 1 day, tomorrow's the next, right? So that's 2 days. So as long as we get that, I don't want to put time limits on it because people don't hit me up at 6 p.m. on Thursday asking about a flock because it's just sometimes it may not happen. Okay, as much notice as you can give us, but absolutely. Of course, we're gonna need your headshot and stuff like that, but we can get that to my team today and possibly have a chance to do this tomorrow. But if you guys want to swing by between like 9 to 5 tomorrow, we can have you know, stack of flyers here for you to pick up. For your online, you guys still with us? Any questions? Because we're concluding now. Now's the time not to be shy. By the way, follow us on social media. Every loan officer in here has an Instagram, Facebook. You can follow them individually. You can follow the company overall, Monarchist Mortgage, on Facebook, Instagram, on YouTube. It's just Monarch Mortgage. And we also have a website. Any of the products you saw today that you're interested in is on our website, monarchismortgage.com. So you guys ever have somebody you want to send a flyer to, you can go on there, download a flyer, shoot it over to your client, or what have you, okay? That's it. I hope you guys enjoyed it. Any further questions, feel free to reach out to us. Did I miss anything, team? Anybody? No? I think everybody's ready to eat because we been learning, but we didn't get much lunch in. So see you guys next time and have a great day.